Yo, what's up guys? In today's video, we're going to be going over my trading plan. This is going to be a long video. This is going to be a very informative video. So pay attention and let's get right into it. I wrote up this Miro board for you guys. Let's get right into the breakout trading plan, right? So this trading plan is inspired from screen time, myself obviously putting in work, and then also my top three inspirations are Dan Zanger, Qualamagi, and Mark Minervini. These are three guys that I really look up to that have made tens and hundreds and millions of dollars trading stocks in the stock market from swing trading. So let's jump straight into it. Right now, the core trading philosophy that I like to get into is you want to trade high momentum stocks, right, that are already showing strength. Those are most likely going to be the best setups. Now, we're going to give, obviously, examples of setups that haven't showed the best strength but still worked out, right? They don't always have to be a flag pattern, but I would say the best of the best setups, like that really continue higher and higher, are the ones that have already showed momentum and that are showing strength, right? Now, the second thing is you want to look for clean consolidations after strong moves up. You don't want to look for like insanely choppy, sloppy market conditions, right? You want to look for a really good tight setup, right? Higher lows, lower highs, and you want to look for the consolidation that is a clean consolidation. The third thing is entering stocks that break out of the pattern of the resistance with high volume. The fourth thing is manage your risk with tight stops and also scale out into strength. So what that means is keep a tight stop, you know what I mean? Don't risk over 25, even 30% max. You know what I mean? You don't want to risk that much on a trade because it would just, you know what I mean? You're going to have a big loss, and it's better to just cut the loss quick, understand that you lost the trade, and to just move on. That's the best way to go about that. So make sure you're keeping your stop losses very tight, and then also make sure that you're scaling out into momentum. So you don't want to be that greedy trader that holds onto a position forever. When you see a trade, you know what I mean, hitting that 30 to 100%, and it's gaining a lot of momentum, it's pushing up super hard, it's pretty extended, scale out, you know what I mean? Take your profits, not all of them, but make sure you're obviously scaling out of the position. So let's dive into the actual criteria. Let me get this off the screen. So you can see this is my setup criteria, what to trade. So number one, right? The very first thing that you're going to look for is the very first prior move, right? Now this is for most likely like a bull flag type of pattern. So the stock should have already moved up plus 15 to 100% in the last few weeks to months, or even maybe a year it might have been. You know what I mean? But most of the time we're looking for momentum from past weeks or months. We want to see a big upside move, and we want to show, or we want to see that clear institutions are buying. So let's just give an example on the stock Jobby right here, right? You can see right here from down here, this base breakout, you can see that the stock moved insane, right? It like over 100% move up, pulled back, broke out of this consolidation range, and then started flagging. You see this area right here of consolidation? You can see we made an upside move out of this prior breakout. You could have taken it right there. That was a good breakout, but I want to talk about this recent breakout. You can see we make that upside move, we break out higher lows, lower highs, and you can see we're surfing on the 10 EMA and the 20 EMA. If I take off the support line right there, you see the moving averages, you see how the price is literally floating on the moving averages. That is exactly what you want to see in order to see that tight range, right? You don't want to see stocks that are chopping like that. You see how it's just a super tight range and it's consolidating after this breakout. And then you can see we obviously mark out our highs right there, and we had a strong breakout through that level. That was a beautiful breakout. So you can see what we were talking about, the first prior move. You see, like if we go to a weekly time frame, see this prior move right here, huge move up out of this base right here, pulls back, you know what I mean, starts chopping, breaks out, right? So the first prior move, you want to see plus 15% to 100% up before it obviously starts tightening up. Remember, we're not taking random setups. We want to take the setups that are showing strength, showing momentum, and that actually have made a move. You can see that the institutions are buying them. That's the most important thing. Now, number two is the base formation, right? Whether that's the flag, a wedge, or even a base, it's the formation and the consolidation formation, right? You usually want to see consolidation last from 3 to 10 days. So if we go on Jobby right here, you could see, let's even just put this in replay mode and look at this breakout right here, right? You can see we made a big upside move, we pull back. See how long we've been consolidating right here? So let's take these lines off. look at how many days. Look, 1, 2, 3, 4, 5. I'm not going to count all of them, but you can see that's way more than 5 to 10 days, right? So see how we're just chopping and we're getting super tight on the moving averages, and then what happens out of that? Bang, breaks out with a lot of momentum, and you would be swinging that whole entire time, because you could see it never ended up breaking below the 10 and the 20 EMA. So you see how we made that upside move, we pulled back, started chopping, and kept going higher. You want to be holding that stock the whole time and target these highs up here. That's how we usually go for our swing trades. So yeah, 3 to 10 days long for the consolidation. A tight range, obviously after those highs are made, are basically showing that buyers are still in control, right? So if we zoom in, if we see a big upside move, and it's flagging like this, does that mean sellers are in control? No, it just means a lot of people are, you know what I mean, taking some profit up here. Buyers are still buying, and you can see the stock is getting tight. Now, when you see a big upside move, and then it just falls and rejects, that's how you know that sellers are in control. But when you see a big upside move, and it puts in lower highs, higher lows, and it starts flagging, creating a tight base like that, a tight flag, that's how you know that buyers are still in control. They're loading up shares, loading up that position to then create that next leg up. And that's the exact leg that we're looking for, just like this leg or even on this breakout right here. And we're obviously wanting the stock to go higher. Now, the third thing is the moving averages. Obviously, we've been talking about that. The moving averages are probably one of the most important things in my trading. I watch them every single day, and they're basically like a guide. And it's basically like something protecting you at all times. The moving averages are literally your freaking second-hand man. If we're holding the moving averages, it's your best friend, right? So moving averages are your most important criteria within your trading. You need to pay attention to them. Now, I used to use the 50 EMA. I don't use it anymore. I know Mark Minervini and Qualamaggie uses them, but I use the 10, the 20, and the 200-day moving average. You can put on the 50. It's more of a long-term moving average, but I'm simply using the 10 and the 20. They are my main EMAs, right? Now, those EMAs are basically just showing me where price is supporting. So you guys already know, we've went over it. You could see how the EMAs are being supported right here. That's how you know we're in an uptrend. And now look at the price right here. The EMAs are above price, and we're rejecting off of the EMAs. So it's like a support and resistance, and it's basically just a really good guide to hold your trades, right? We're holding our trades as long as we're above the moving averages. So let's say we took Jobby down here. Like, we would have held that whole entire position until, you know what I mean, it started breaking below the moving averages over here. Now, the moving averages are, like I said, the number one thing that I'm looking for with these breakouts. After, you know what I mean, a big upside move, it pulls back. You want to see price curling up on these moving averages, getting really tight and low volume. You can obviously see volume was decreasing, and then we actually popped out of that. You can see volume made an actual move. Now, the next thing is relative strength, right? Stocks that have relative strength are the most strong stock in the market, right? You don't want to look for weak stocks. You don't want to look for relative weakness. You want to see maybe QQQ struggling, or even if it is moving higher, you want to see a stock that is really moving. If you see a stock that's holding its momentum, it's making higher lows and higher highs, going higher, and it's really showing strength, that is relative strength. What relative strength is when an overall stock is showing strength when compared to the actual market, it's showing weakness. So that's what you want to look for when you're looking at these breakouts. Relative strength is very, very important. You want to see that if the market's pulling back and the stock is holding up, that's what you want to see in order to actually hold and swing a stock. Now, number 5 for my main criteria is volume, guys. Volume is the number one, like, with the moving average. Volume, the moving averages, those are like the back-to-back, like, things that I'm watching. I want to see price curl up on the moving averages, and then I want to see volume through my breakout level. So volume dries up during consolidation after a big move, and then once you see the breakout, you want to look for actual volume and momentum over our breakout level to confirm that the breakout is actually happening. That's how you don't get stuck in fake outs, and we've been over that in the before in the couple videos before this video inside of this course. So volume is very important. You want to see, you know what I mean, when you see give me 1 second, let me go in replay mode. When you see this right here, look, so you see how, you know what I mean, price is consolidating. Look at the volume on this. There's no volume, super thin candles. You can see volumes even decreasing down here, and in this day we have a lot of volume. So if we go to like the 5-minute candlestick, when we broke out, you can see, just look at the volume that we had. Like, you're entering right off of that as soon as we get above these highs, or above breakout level, which would be previous day high right here if I remove the trend line. Obviously, we're looking for that previous day high, right? You could see we're wicking it at market open, and then we see a big surge in volume. That's where you want to enter. You can enter on the first 1 minute candle. Like, let's say if we go to the 1 minute, you could have entered on, let's say, like this candlestick up here, or you could have waited for the 5 minute, which would be a little bit higher. It's very important to focus on risk to reward as well. But let's go into my entry rules, right? Since we already talked about the main criteria, what we're usually looking for, I want to go over the entry rules and where I'm looking to buy these stocks. Now, as price breaks over the trend line or the prior highs, previous day highs, that's where I'm looking at, right? So you can see this is a pure example of where I would have entered, right? You can see like our trend line obviously isn't here now, but this was our trend line, right? You see how price is getting super tight, just moving sideways. This is our breakout day. This is the day we're looking to enter the stock. So you can see previous day high is simply just yesterday's high of day. Does that make sense? So what is the highest point on this previous day? Right here. You see how this was the highest point in the whole day? Right up here. So that's what we're going to look to get broken over, right? So you can see if I go over here, this is the previous day high. We want to see volume through that. Let's go back to a 5 minute time frame. And you can see how we consolidated the first 15 minutes of market open, and then 9:45, we saw that surge of volume. That's where your entry is going to be. Whether it's getting above that level with a lot of volume, you can anticipate it before the close. You can. It is more of a fake out if you do that. Now, if you wait for the closure and enter all the way up here, you can see your risk to reward's not going to be as good. You can't put your stop loss all the way down here if you're entering that high. But let's say if you're entering right as we're breaking out, your stop loss can be like this at low of day. So you don't have to risk as much. Does that make sense? And you won't get faked out. So remember, risk to reward is like a very important thing with your trading. And you want to make sure that you're not entering too high, but also you don't want to, you know what I mean, wait too long for a pullback, because sometimes when stocks break out, they just go and they don't pull back. So it's very important to, you know what I mean, watch the breakout level, watch for momentum. You can look at like a 1 minute time frame. As soon as we start getting above that, you can take it, or wait for the 5 minute close. Whatever works best for you. I always tell people to, you know what I mean, journal their trades and see what's best for your breakout. Because everyone at the end of the day trades differently. Everyone has their own personality in trading. You can't just copy someone 100%. You got to figure out what's best within your trading. Now, what you want to do, I kind of already explained this, is enter as close as the breakout level as possible. You don't want to chase those stocks, right? You don't want to enter when it's already up 7% all the way at those highs. You want to enter as close as breakout level as possible. Remember, that makes the risk to reward the best. Now, for the confirmation of the actual breakout is you want to see the fast surge with volume. What a surge means is you want to see the candlestick actually rip. You see how we have small candlesticks, not a lot of volume, and then right here, we have a lot of volume. We pick up, we absolutely rip above breakout level. You're entering anywhere around here. Obviously, you could have waited for the 5 minute close, or you could have waited for the 1 minute, or just took it off of the volume. Stop loss goes to low of day or back into the range. If it fails, it fails. You cut your stop loss, or you cut your trade, you stick to your stop loss, and you avoid taking big losses. Because at the end of the day, you're never going to be able to avoid losses, but what you can avoid is big losses. So when you keep, you know what I mean, small losses, and you let your winners actually win, that's how you can become very profitable within your trading. Now, the entry timing is also important. You don't obviously have to be like insanely 100% precise with your entries, because obviously like we're taking 2 weeks out sometimes, maybe even a month out contracts, so they don't move as much. But you still want to be precise, you know what I mean? You don't want to just take random entries. So you want to time it, obviously, within that first day, because that's where the most volume is coming in. Obviously, that first like 9:30 to 10:30 Eastern time. Now, let's talk about your stop loss rules, right? Your stop loss rules are usually going to be, I'd say, around negative 15% to negative 25%. That's usually a good stop. If you see the stock failing, it's not really holding with volume, or it's below your entry or below breakout level, or even at low of day, just stop out. You know what I mean? There's no reason to hold a trade and just hope for it to go back up. You're never going to win like that. That's just hoping and guessing and gambling. So make sure that if the breakout fails intraday and it's breaking like $2 to $3 below your breakout level, it's just failing, just cut the loss. You know what I mean? Take that negative 15 to 25% loss. And remember, you can always re-enter if the risk parameters do align. Now, always respect your stops. It's super simple. Like, that is the number one key in trading. If you're not going to respect your plan and respect your stops, you'll never make money. Now let's go into the take profit strategy, right? This is also very important. You need an entry strategy, you need a take profit strategy, and you need a sell strategy. An entry strategy is just as important as a sell strategy. It's very important. So personally, this is what I'm usually doing with my take profit strategy. My first trim, like my first target, my first trim where I'm actually taking some off, where I'm taking some green, is usually I'm selling like 20 to 30% of my position. Now, let's say if I have 100 contracts, that means I'm usually selling like 20 to 30 contracts if, my TP hits. And usually my TP is around, I'd say, 25 to 40%. I did write 30%, but that's just because sometimes you do want to let your wins win big, but you don't also want to be too greedy. So I'd say when you're up, I'd say about like 25 to 40%. Obviously set your targets and take your profits around there. 30 to 40%, I think that's the first trim. I feel like a lot of people will take their first trims at up 15%, up 20%, but that just lowers your risk to reward. You know what I mean? If you're taking a 20% loss, why would you trim a big position if you are only up 20%? That's going to make you, you're going kind of even right there. So you want to make sure that you're taking your first trim around 30 to 40%, simply because, the amount of money that you're putting in there, you want to let that money work. You don't want to trim too early because then you're not giving yourself enough room to make a lot of money. So, I'm usually selling 20 to 30% of my position around that 30 to 40% up mark when I'm in a trade. Now, scaling out, this is also very important, right? You want to sell more of the stock when you see a lot of momentum. So let's give an example. I took the stock Chipotle, right? Now, this was a falling wedge pattern. This is a very oversold stock, and it was falling super hard into a level of support. You can obviously see from back here, we have a lot of support over here at this area, and also we have a lot of resistance that is now turning into support. So if we look over here at Chipotle, right, a lot of resistance, you can see the stock actually rejected super hard right there. Pull back to right now, you can see we're supporting that exact level, right? So look at that level being supported, very, very nice. And you can see that if I just take off all of those lines, look at Chipotle, falling, making lower highs, higher lows, consolidating, right? This isn't choppy, like bad consolidation. This is really good consolidation. See how it's building this wedge right here? It's building a nice base. So I saw these highs that were stacked up. You see how perfect these highs are? I wanted to see the breakout through those highs. Go on the 5-minute time frame. You can see, I'll show you my exact entry. You see the first 5-minute candle kind of closed above the breakout level, but I wasn't too confident on that close. Pulled all the way back, bounced, and I took it as soon as we saw that bounce. So look how that second candle closed. That was an amazing candle close. We got some volume. I took it right before it closed. Stop loss goes to low of day, and the stock absolutely ripped for the whole entire day. And you can see it closed at these highs. I'm currently swinging this. I think I'm up 90% on this position, but looking really good. And you can see I was scaling out into momentum. So what I was getting at, why I actually showed this stock, is see how we made a huge move? You need to be scaling out on those big moves up. If I'm up 50 to 60%, I'm 100% taking at least, 30 to 40% of my position off at 60%. And I'm holding runners, So, and then it pulls back and then you see a huge move again. You want to scale out into momentum. You want to make sure that you're not getting greedy and you're not just holding your trades forever. Don't get me wrong. If I held the full position all day, I would have been up a lot more than I already was. But if it goes all the way up and then just randomly tanks, you're just giving away a greed trade. You want to make sure that you're not being too greedy, but also you're not trimming. So you want to be in that in between. Hopefully that makes sense. So your first trim, like I said, you want to scale out. I'd say if you have 100 contracts, you want to trim 20 to 30 contracts at that 30 to 40% level when you are in a trade. Now, I'm trading options. I'm not really trading shares as much unless I'm investing. Now, runners, you want to keep a good portion of your runners to obviously let them run, right? I'm only out, I'd say 40%, 50% of my position on this. I still got 80 contracts. I went in with more than 100 though, obviously. And you can see I'm just letting this run. We have a long way to go on this stock. You can see it finally got above the key moving averages. We have this gap from earnings that we can fill, and I think this stock has a long way to go up, and this can make me a lot of money. So I'm holding my position. I'm going to see how this ends up playing out. And yeah, you don't want to just sell your runners. Oh, I'm up 200%. I'm going to sell all. Because let's say you're up 200% right here. The stock could easily just pull back and just keep going higher and higher. You could be up 5,000% up here. So it's very important to hold runners. I think that You know what I mean? That's how you're going to obviously make most of your money. You're not going to make most of your money from those little like 30 to 50% moves. You're going to make a lot of your money by letting your trades actually run. That's very important. Now, hopefully you guys understand the whole criteria. I want to go into position sizing. This is very important. So for your position sizing, you never want to risk more than 1 to 5% of your account. That means, like, let's say if I have a $150,000 portfolio, I'm never risking more than like $5,000 on the day. You know what I mean? Because that's around, like, I'd say like what, 3% of my account if you have a 150K account. You know what I mean? There's no reason for me to be risking more than like $5,000 to $6,000 on the day. So that's usually my max loss. Now, we'll give an example for more smaller accounts, right? If you have a $1,000 account, you should only risk, I'd say, like $50 per trade, because what's the percentage of $1,000? That's 5%. Most people will lose like $200-300 on a $1,000 account. If you lose 5 days in a row, your whole entire account is depleted, and then you have to start over. So you want to make sure that you're actually risking properly. You're not just trying to get rich quick, and you're not oversizing to feel that dopamine of trying to make money. You're not going to get anything out of that. You're just going to set yourself back, and you're going to lose more than expected. Your dopamine's going to get fucked up, and you're going to be in a bad headspace. So make sure that you're treating your trading like a business, and you're not just sizing randomly. Remember, random shit in this market is going to give you random results and bad results. So if you have a 1K account, you know what I mean? You want to be putting, let's say, 20% of your account into a trade. That means you put $200 into a trade. If you lose 20 to 25% of that, you're going to lose $50. So that means you never want to lose more than like $50 to $60 on a trade if you have a $1,000 account. So to sum it up to any of your guys' accounts, never lose more than 1 to 5%. That's usually my goal. 5% at max is what I lose. Normally, I'm losing, I'd say, like 2 to 3% of my account per loss. Now, if you're making money, you want to make sure that you're making more than that. You want to be making 5 to 6, 7% of your account on a day. Now, you know what I mean? If that means your stop is 25%, if you size 25% of your account, obviously that has to match the 1 to 5% of the total account, if that makes sense. If you go into a trade with, let's say, $250, you don't want to lose more than $50, $60, because that's around 5% of your account. Hopefully that makes sense. The math is, you know what I mean, a little complicated at first, but once you really write it down and you journal it and you understand what your position sizing should be accordingly to your account, you'll actually get it. Now, I want to go into the actual rules. This is more of like psychology, discipline type of stuff. So I want to go over these because a lot of people have a hard time with this, right? First things first is no revenge trading, right? If you take a trade and you lose and you get upset, that doesn't mean to just go place random trades and try to make your money back. That's never going to help you. It's never going to do anything for your trading but hurt you and dig yourself deeper than you already are in that hole, right? If you know what I mean, you take a decent loss, whatever, just go accept it and move on. But most people, they revenge trade and they continue to trade to make that money back, and they end up digging themselves deeper and taking an even bigger loss. So you need to stop doing that. Another thing that you need to stop doing is stop adding to losing trades. If you're losing a trade and you're down 10%, 20%, don't average down and add more to that trade to, you know what I mean, add more to hope it goes up so you can make more money. That's never going to do you any good. If anything, it's only building bad habits, and you're only going to end up losing more. Same thing as revenge trading. Now, you never want to chase breakouts. You don't want to get FOMO. There's no reason to get FOMO. FOMO is not even real. It's literally a mindset thing. So focus on your mindset. Focus on becoming the best trader possible, and don't get FOMO in trading. The FOMO is not real. Remember, if you can just become the best version of yourself and tell yourself, oh, I missed a trade. Who cares? I'll get the next one. Be disciplined with that type of mindset. Don't give a fuck. Who cares? Just be yourself and just stick to the plan. You know what to do. So next thing is no holding and hoping. So if it hits your stop loss and you're just trying to hold it forever and just hope for it to go back up, dude, that's just gambling at the end of the day. Stick to your stops and respect them. No over trading, only A+ setups. Always follow your stop loss, and always size smaller if you're a little bit unconfident. If you're unsure about the setup, but you still like it, just size lower. You know what I mean? Don't put as much risk on that. So that's the rules. Now, the last thing is the mindset, right? This is not about just catching every single move. It's not about trading every stock, trying to get rich. This isn't day trading back and forth. It's none of that. This is long-term swing trading. This is investing, and this is how you're going to make a lot of money over time. It's not just catching every move. It's about protecting capital and waiting for the best setups to align that meet your criteria. Discipline and patience is the real edge. Most traders do not have that. They try to get rich quick and wonder why they get washed out very quick. I do not predict any of these setups. I don't just hope for setups to work out. I react and I trade based off of my plan. My only job is to execute from my plan, and that's about it. So I hope you guys enjoyed this video. This was a very informative video. Make sure to join my free Discord, link in bio. And yeah, let's keep crushing it. Let's keep working every single day. Yeah, love you guys. Peace out.